For moderate investor, 35% bond, 5% cash, and 60% in mutual fund. Same thing. So for the U.S. investors, U.S. moderate investor, like I would say for bonds, I bonds is the best. At least unless if you think otherwise, please comment on my channel. You know, uh, yeah, I'm more than willing to look into your questions, and then maybe perhaps I can create another video on iBond itself. But to my understanding, my research, iBond is the best. And then for mutual fund, again, you're moderate. You are in this circle now. In this, I say 60% mutual fund. You can split this into 30 30% in mutual fund, index funds, and then add like uh, 30% in stocks, and right. But you're a beginner. You don't. You're a beginner. I believe like you don't have a lot of understanding. I want the core. The problem with a lot of investors is that like they try to complicate when at the beginning. So the beginning you want to just get started. You don't want to do this, do that, blah blah blah. You just want to make your life as simple as possible, keep it as sweet, right? So therefore, like somebody can argue that okay, this 60% can be split into two, and then you can put half another portion in stocks. You can do that, but for somebody who is just beginning, I would just suggest like keep your portfolio as simple as possible. Invest in index fund, VTI or SCHD. As I said, either one will do. See, for longer horizon, both are doing well. Swap seems to be much better because given that it has had that dividend. So yeah, so either would do good. For moderate investor in Canada, say 30% in bond, 60% in index fund, cash, 5% gold, 5%. Okay, I forgot to talk about gold here. The reason I wanted to invest in gold, so for example, this is a comparison between TSX and gold. So if you're from Canada, why you want to invest in gold? So year to date, if you think about it, uh, see compared to the TSX index, the gold is has not fallen that much. It's just down 0.29%, whereas TSX is down 3.35 percent year to date. If you compare 1 year, actually gold is beating the index by 1.57%, whereas this is 1.14. The TSX is down 1.14. If you think about 5 years, um, again gold is beating TSX by like lock, stock, and barrel. Like it is like 41.66%, whereas TSX is only 27.52%. So that is why, as a Canadian investor, I believe like some of your portfolio can be in gold. Now, coming back to this gold, whether you want to whether you want to invest in the physical gold or buy a GLD ETF, it's up to you. There is no specific preferences. It's totally up to you. But if you want to keep your life easy, since you're investing in index fund, I would I would just go and buy GLD ETF, right? So GLD ETF. So the ETF that I showed here, not this one, Spider Gold Trust. This ETF, I will go and buy it. It is sold in ETFs format. So you don't need to buy and hold that gold in your locker or whatever. It's just like anyways you're going to buy index fund, you might as well buy gold ETF. So I would, my pick would be GLD ETF, and that's it. And coming, so just to summarize, so if you are a Canadian moderate investor, you would invest like 30% in bond, 60% in index fund, 5% in cash, and 5% in gold. As far as gold is concerned, you would invest uh, to make your life easy. Go and invest in ETFs. As far as index funds is concerned, similar idea, like as I talked about in the earlier slide, it'll be like 15% in VCE and 85% in VUN. This is just to because avoid the country bias and diversify as much as possible, which is one of the key idea of asset allocation, right? And then, and as far as the TD, the bond 30% is concerned, I would go with TD Ultra Short Term Bond. You know, um, as I explained, it it seems to be much better choice compared. The reason is like I told you, like, so if I go back here, um, so if I go back and if I type, this is iShare Core Canadian US Bond, like, you know, if you think about 5 years, it's down 10%, and 1 year it's never up. I think it makes sense only short term, as I said. Like if you hold anything for short duration, then it's fine. But as you if you want to keep it for long term, then these bonds doesn't make sense. That's why you might as well hold an ultra bond fund, which is like I'm just suggesting TD. You can go and invest in other ultra short term bond. The main key thing I would suggest here is to pick a one that is low MER, right?